Happy Friday, everybody. Now, these weeks make the weekends more and more necessary. Don't you agree? Now, before we get into today's topic, I need to remind you these videos and this video specifically is for informational purposes only, and it is not a prediction. It's not personal investment advice. It's not a recommendation to buy or sell anything right now. Markets involve risk, and past performance doesn't guarantee future results. Everybody's situation is different, so before you go make changes to your portfolio, please let's talk it over. Now, have you ever noticed when markets hit new all-time highs, it somehow feels dangerous? I used the line yesterday that oxygen is thin up here. Clients will call and they'll say, Randy, aren't we due for a drop? Shouldn't we wait until things come down before we invest more? Now, it's a reasonable question. After all, buy low, sell high. It sounds simple enough, but here's the truth. Most all-time highs aren't the end of a run. They're just another mile marker along the journey. Now, we've been conditioned to think that new highs are a sign of trouble ahead, and that we've reached the top and gravity's about to take over. And yes, sometimes new highs are followed by pullbacks. In fact, sometimes they're followed by steep corrections. But here's the part most people miss. Almost every single long-term bull market in history has hit dozens, sometimes hundreds of new highs along the way. If you've been investing for more than a few years, you've lived through it. Think back in 2013, the market broke above its pre-pandemic or its pre-2008 high, and plenty of people got nervous. Fast forward a decade, and that scary new high looked like a bargain in hindsight. I remember a conversation in late 2019. The Dow had just crossed 28,000 for the first time. A client called. They said, Randy, I think we should take some chips off the table. This can't last forever. And she was right. It didn't last forever. Within months, we had a pandemic crash. But here's the kicker. Even with that sudden drop, by the end of 2020, the market had recovered and pushed to, you guessed it, a new all-time high. If she had sold in late 2019 and never gotten back in, she would have missed an enormous amount of upside. This whole too high talk reminds me of a couple of great movie moments. Now, first in the movie Major League, there's that scene where one guy smashes a home run and the crowd goes crazy, except for that one fan who says, too high. His buddy looks at him and says, what do you mean too high? It's a home run. And the guy just shrugs, can't even explain it, just felt wrong. And then there's another scene where the team's on a winning streak and somebody says, we're on too much of a roll, we're due to lose. And of course, they just keep winning. It's the same in the market. People see new highs and they think too high, we must be due for a drop. But as they said in The Princess Bride, you keep using that word, I do not think it means what you think it means. In long-term investing, too high usually means you're on a track, like a home run sailing over the fence or a winning streak you don't want to walk away from. Fear of new highs is a short-term mindset. It's rooted in the idea that what just happened is about to reverse. Psychologists call this recency bias. When we see the market going up, we assume it's overdue to go down. If you want more information on recency bias, I spoke about that Friday, July 18th. Go back and check that video out on my YouTube page. But the data tells us a different story. Since 1950, the S&P 500 has hit a new all-time highs more than 1,300 times. That's an average of about 20 new highs a year. And in many of those years after hitting a new high, the market went still higher. It doesn't mean that there's no risk. Pullbacks and corrections happen, often and without warning. But the presence of a new high is not in itself a reason to run for the exits. When you're a long-term investor, you recognize that new highs are a feature, not a bug of investing. Without them, your portfolio wouldn't grow. The market doesn't stop at one high. It climbs, it falls, it consolidates, and then it climbs again. What feels expensive today often looks cheap in hindsight. Think about the first time the S&P 500 crossed 1,000, then 1,100 in 1998. People thought it was frothy. Today, that level is barely visible on a chart. For a little history, in 2013, we broke above the 2007 highs. In 2016, markets made new highs after a rough start to the year. In 2020, despite the fastest bear market in history, we finished with record highs. In 2021, we set 70 new all-time highs in a single year. Each time there were headlines warning of bubbles, overvaluation, and the top is here. And yet, for long-term investors, these were stepping stones, not cliffs. This does not mean that we don't do anything. So, what should you do when we're at new highs? Here are a couple of ideas. Let's check your allocation. You've heard me say this for months now, a risk audit. If your portfolio is properly diversified and aligned with your time horizon, you can weather the inevitable dips. Stick to your plan. Investing isn't about predicting the next 3 months. It's about preparing for the next 10 to 30 years. If we're planning for short time frames, as many of you are, we have a different plan for that. Avoid emotional trading. Now, selling just because we're too high often means buying back in later at even higher prices. Now, let's also think about using volatility to your advantage. If the market does pull back, it's often a time to talk about making changes. Rebalance regularly. This is naturally taking some profits from high performing areas and adding to lagging ones without trying to time the market. Yes, we are at new highs right now. And yes, at some point, the market's going to pull back. That's not a warning, it's a fact of life in investing. But if you zoom out past the day to day headlines, past the quarterly ups and downs, you can see a clear trend. The market history is a staircase of new highs interrupted by temporary declines. Each new high we see today is just another step in a much longer climb. So instead of fearing new highs, recognize them for what they are. Proof that long-term investing works. This is a good time to remind you, so compliance is happy and everybody else, this is not a prediction, and past performance does not guarantee future results. If you're feeling uneasy about today's levels, please let's talk about it. Sometimes the best antidote for market anxiety is a solid plan, a little perspective, and the reminder that you're investing for a future that's a lot bigger than this week's chart. For now, take a deep breath, have a great weekend, and I'll see you next Friday.